Have you ever wondered what truly fuels the explosive growth of today's e-commerce giants? Is it simply traditional bank loans, or is there a more innovative financial engine at play? For many rapidly scaling online businesses, the answer isn't always straightforward debt. Instead, a new breed of financial partner has emerged, one that promises flexibility, speed, and a deep understanding of the digital marketplace. And at the forefront of this revolution is a company called Wayflyer. But here's the burning question that many aspiring entrepreneurs and even seasoned business owners are asking: is Wayflyer a lender, or is it a revenue-based financing platform? It might seem like a semantic distinction, but understanding the core difference is crucial for any e-commerce business looking to secure capital for growth. Because the implications for your cash flow, your equity, and your overall business strategy are profound. To unravel this, we need to first understand what each of these terms mean in the context of business finance. A traditional lender, like a bank, typically provides a loan with fixed repayment schedules, often requiring collateral, personal guarantees, and a thorough review of your credit history and assets. They operate on a model of predictable interest payments, regardless of your business's day-to-day performance. This can be a great option for established businesses with strong credit and consistent, predictable revenue. However, for the dynamic and often unpredictable world of e-commerce, this model can present significant challenges. E-commerce businesses often have fluctuating revenue streams, high working capital needs for inventory and marketing, and sometimes limited physical assets to offer as collateral. Traditional banks, with their often rigid underwriting processes, can be slow to adapt to these new business models, leaving a significant funding gap. So, where does Wayflyer fit into this picture? From their own messaging and the experiences of thousands of e-commerce merchants, Wayflyer unequivocally positions itself as a revenue-based financing platform. They are not a traditional bank offering fixed-term loans with rigid interest rates. Their entire model is built around the principles of RBF, tailored specifically for the unique needs of online retailers and direct-to-consumer (DTC) brands. Let's break down why this distinction is so important and how Wayflyer embodies the revenue-based financing model. Firstly, Wayflyer's core offering involves providing upfront capital in exchange for a small, agreed-upon percentage of your future daily or weekly sales. This repayment mechanism is the hallmark of RBF. Unlike a bank loan where you have a fixed monthly payment regardless of your performance, Wayflyer's repayments ebb and flow with your revenue. If you have a blockbuster sales month, you pay them back faster. If you experience a dip, your payments adjust downwards, easing the pressure on your cash flow during leaner periods. This flexibility is a game changer for businesses that rely on unpredictable consumer demand or seasonal trends, allowing them to manage their working capital far more effectively. Secondly, Wayflyer focuses heavily on data-driven underwriting. Instead of scrutinizing personal credit scores, collateral, or extensive financial statements that might not fully capture the agility of an e-commerce business, Wayflyer integrates directly with your e-commerce platforms like Shopify, WooCommerce, or Magento, and payment processors like Stripe. They analyze your sales data, marketing performance, and overall business health in real time. This allows them to assess your growth potential and offer funding amounts and repayment terms that are truly customized to your business's unique trajectory. Thirdly, Wayflyer emphasizes non-dilutive funding. This is a massive advantage for founders who want to retain full ownership and control of their companies. When you take on venture capital or angel investment, you often give up a portion of your equity, which means ceding some control and sharing future profits. With Wayflyer's RBF model, you are essentially selling a portion of future revenue, not a portion of your company. This allows entrepreneurs to grow their businesses without diluting their ownership stake or answering to a board of investors. It aligns Wayflyer's success with your success. The more you grow, the faster they get repaid, incentivizing them to provide not just capital, but also valuable insights. And this brings us to another crucial aspect of Wayflyer's platform: insights and analytics. They aren't just a funding provider, they aim to be a growth partner. Leveraging the same data they use for underwriting, Wayflyer provides e-commerce businesses with actionable insights into their marketing spend, inventory management, and customer acquisition costs. This advisory component helps businesses optimize their operations and deploy the capital more effectively, ultimately accelerating their growth. This holistic approach, combining funding with strategic guidance, further distinguishes Wayflyer from a typical lender. Traditional banks provide money. Wayflyer provides money and the tools to help you use it wisely. Consider the typical e-commerce growth cycle. A brand launches, gains traction, and then needs to scale. Scaling often means increasing inventory to meet demand, investing more heavily in marketing to acquire new customers, and expanding into new channels or product lines. These initiatives require significant upfront capital. Traditional loans might be too slow, too rigid, or simply unavailable to a burgeoning e-commerce brand that doesn't fit their conventional risk profiles. Equity funding might be an option, but it comes at the cost of ownership and control. Let's look at some tangible benefits that highlight Wayflyer's RBF nature. Flexible repayments. No personal guarantees or collateral. Speed of access. Focus on growth metrics. Transparent fees. While some might still broadly categorize any provider of capital as a lender, it's vital to appreciate the nuance with Wayflyer. They are not simply lending money in the conventional sense. They are engaging in a partnership where their return is directly linked to your revenue generation. This is a fundamental philosophical shift from traditional lending. A traditional lender assumes a fixed level of risk and expects a fixed return regardless of your business's daily performance. A revenue-based financing platform, like Wayflyer, shares in your commercial success and indirectly your challenges, making their incentives much more aligned with the merchant's growth. In conclusion, Wayflyer operates firmly within the realm of revenue-based financing. They have carved out a niche by understanding the intricacies of the e-commerce landscape and developing a financing model that is agile, responsive, and aligned with the growth trajectories of online businesses. They offer a compelling alternative to traditional debt and equity financing, providing rapid access to capital without diluting ownership or imposing rigid repayment schedules. So, if you're an e-commerce business owner seeking capital, remember this: Wayflyer isn't just a lender, it's a strategic financing partner designed to help you scale on your terms. With that said, thanks for watching, and until next time.